Hey guys, Ron Parks here and welcome back to the channel. I am going to walk you through the 7 must-have investments, no matter your age or how much assets you have. You can buy into all of these now or when you're at the right stage in your life. And since tax filing just finished on the 15th, if you find it hard to save money throughout the year, consider setting aside part or all of your tax refund as a way to get started with investing. It is usually the only time of the year that you will get a windfall, which you did not probably account for. Okay, so let's get right into it. I know all of you want to make tons of money and become financially secure, but I want to lay it on the line here. Investing in these products are probably not going to get you rich, but they will be a safe and secure starting point for growing a portfolio that you can use at retirement. And talking about these products, let's start with number 1, savings accounts. You might say, who invests in savings accounts anymore, considering that the interest rates are around 1%. But for those of you just starting out, the first investment vehicle should be a savings account. We all need an emergency fund, and this is where you place the money. It's liquid, it's safe, and it's insured. And you can grab the cash anytime you need it, but mainly for emergencies. I would go check out online banks such as Ally Bank and Discover Bank. I'll leave a link below. You will usually get a higher interest rate as they have no physical buildings and their overhead is much lower than traditional banks. They pass those savings along to you with a higher interest rate. As of May 2020, you can find accounts paying above 1.5%. They are mostly insured with the FDIC, so check and make sure before you drop your money. You want to follow these criteria. The account should have no fees, it should pay at least 1% interest, and it shouldn't require a minimum balance. You can also put some short-term money in money market accounts. Now, money market accounts typically earn higher interest than savings accounts, but they require a little higher minimum balance. And because they're relatively liquid and earn higher yields, money market accounts are a great option for your emergency savings. But in exchange for a better interest rate, you'll have to accept more restrictions on the withdrawals, such as limits on how often you can access the money. And this is a great option for beginning investors who need to build up a little cash flow and set up an emergency fund. Okay, number 2, index funds. This is my go-to investment. I have almost 25% of my portfolio invested in index funds. So when you think of an index fund, think about a bucket filled up with all different kinds of companies, from A to Z, from Apple to Zillow. Even if you're new to investing, you've likely heard of the S&P 500 index. In a nutshell, the S&P 500 is considered to be a good benchmark for the general health of the US stock market. They're large cap companies, typically ranging from $10 billion to $200 billion, and include the kind of industry titans that you'd expect to see on major stock market indexes like Berkshire Hathaway and Walmart. And because you're investing in the top 500 companies, you have reduced your risk of loss because you have diversified automatically. If 1 or 2 of the companies in the index go belly up, then other companies that have done well will reduce your loss. For example, you can go to Vanguard and buy an S&P 500 ETF, which will cost you around $295 for a share. Now, this mutual fund is a popular index fund with the objective of replicating the S&P 500 index. And an index fund is an excellent choice for beginning investors because it provides broad, diversified exposure to the stock market. It is highly liquid, as you can sell any piece of your investment any day. Now, there are so many other indexes, such as the Dow 30 index or the Russell 2000 index, which actually represents the small cap companies. You can also invest in some of the largest technology companies by putting some money into a NASDAQ 1000 index fund. But make sure you look for funds that have a very low expense ratio, no more than $2 to $4 per every $10,000 you invest. That's the fee you pay on your assets invested to have someone manage it. And in most cases, it's better to have someone manage it than you managing it yourself. Okay, now this one is my favorite. Number 3, become a landlord and get free housing. Well, rental housing can be a great investment if you have the willingness to go through the home buying process. And to pursue this route, you'll have to select the right property, finance it or buy it outright, maintain it, and deal with tenants. You can do very well if you make smart purchases. If you select the right property, the rental income from the units you rent can pay for the home's mortgage and property taxes, which are the highest expenses. Then you take one of the units to live in and your housing is free. However, you won't enjoy the ease of buying and selling your assets with a click of the mouse. Housing is not very liquid, and it takes time to sell the property. So if you need an investment where you can convert the asset into cash quickly, this one's not for you. And worse, you might have to endure the occasional 3 a.m. call about a broken pipe. But if you hold your asset over time and gradually pay down debt and watch the appreciation in the market and grow your rents, you'll have a powerful cash flow when it comes time to retire. And once you do the first one, you'll have a template to buy more properties. Now, if you don't want to go through all of this, but want to invest in income-producing real estate, you can contribute to a real estate investment trust, or called a REIT, and let the professionals manage the real estate portfolio. Now, these funds are usually traded on the stock exchanges. Number 4, a Roth IRA. You can open up a Roth IRA at many companies: Fidelity, Vanguard, Charles Schwab. Well, the Roth IRA is similar to a regular IRA, but you pay taxes now on your deposits into the account. And when you retire, you take money out tax-free. It is a great way when you are young to set money aside tax-free. And 2 things. Make sure you sign up with a good company that will not only provide many ways you can invest the money, but also has great customer service. Number 5, the stock market. You can invest in the stock market by just opening a trading account with any one of the large brokerages, such as Charles Schwab or Vanguard, or an account with Robinhood, which has free trades, no commission, and also will allow you to invest in fractional shares of any company. But just be careful here, because lots of people are using the Robinhood app trying to make a quick return, and most fail. Recently, a young investor committed suicide because he screwed up trading options and owed over $700,000 as he wasn't aware that he was trading options on margin. So if you're not comfortable picking individual stocks, then you can spread the risk by buying fractional shares and spread your money around, or invest in index funds. That's the way to go. Okay, number 6, get a side gig. I always believe the first thing to do is invest in yourself. If you work 9 to 5, then think of the hours from 6 p.m. to 1 a.m. as time that can be used for a second gig that will bring you some extra money. If you're a software engineer, there are lots of companies that need help on a consulting basis. If you teach, there are many families that need private tutoring for their kids. And if you're a real estate agent, like I am, you can try and start flipping houses. This is a real investment in your financial future, as the money you make can be put away and invested right into the market. Now, the last investment is to get a wealth manager. And even if you're starting out, you should consider getting affiliated with a company that can give you unbiased recommendations and can help you build or manage your portfolio. Now, some managers won't take on someone that has a small portfolio, but once you get some critical mass, look into that relationship. Now, since I'm a CPA, I know how I can help. You want to find one early on that you can work with to plan your business, discuss tax issues, and generally be a go-to person for finance questions you might have. Now, I'll leave a link below to my interview with Elliot Elbaz, a wealth manager from Gordian Capital. One of the best investments you can make is to start paying down any debts that you have. Usually you'll have credit card balances that are charging humongous rates. So if any of your debts has an interest rate of 6% or more, I would first use your money to pay these down and put some of the extra money in an emergency fund and wait to do more once your finances are at an equilibrium. I've given you a lot to think about, but if you tackle these items step by step, I can assure you that you'll be on the path to financial stability and success. Well, I appreciate you watching, so please smash the like button for the YouTube algorithm and subscribe if you enjoyed the video. And until next time.